how does an insurance company suffer, like a massive 21% spike in vehicle claims, taking a direct hit to its core business, and yet the stock market still treats it like an impenetrable financial fortress?
Well, I mean, it comes down to invisible architecture. When most of us look at a company's defenses, we look for tangible things, like cash in the bank or physical assets.
The obvious stuff.
Exactly. But in the insurance sector, the strongest walls are built entirely out of mathematical discipline and rigorous risk management. People rarely appreciate those moats until a storm actually hits the balance sheet.
Yeah, which makes it fascinating. So welcome to today's deep dive. I am your host, and my mission today is to unpack the newly released Q2 2026 financial report for Allianz Malaysia Berhad.
Or Allianz, as most people know it.
Right, Allianz. And we are going to cross-reference their latest numbers with the most recent analyst notes from RHB and TA Securities just to see exactly how this mathematical fortress is holding up.
It's a good one to dig into.
Yeah, it really is. But before we start laying the bricks of today's analysis, please do me a quick favor. Click that like button and subscribe to the YouTube channel. It really helps us continue bringing you these deep dives.
So to set a quick baseline for anyone jumping into the Allianz story for the first time, this is an investment holding company that operates primarily through two massive, highly distinct engines.
Okay, let's unpack that.
So first, you have Allianz General, or AGA, which handles your standard property, commercial, and motor insurance. And second, you have Allianz Life, ALIM, which handles life insurance, medical coverage, and investment-linked savings products.
So it's basically two engines powering one massive vehicle. And I mean, tracking this specific stock over the past 2 years has been one of the most interesting journeys for this show.
Oh, absolutely.
Like if we rewind all the way back to our deep dive on their Q4 2024 results, the market was in an absolute panic.
Yeah, it was wild.
They skipped a dividend. We were talking about opaque futures and, severe regulatory challenges. Investors were completely spooked.
But that panic was almost entirely driven by the transition to the new MFRS 17 accounting standards.
Right, the accounting shift.
Yeah, the market fundamentally misunderstood what was happening. Under the old rules, if an insurer sold a 10-year policy, they might just book a massive chunk of that expected profit on day one.
Right.
But MFRS 17 forced them to change that. They had to take all that expected future profit, lock it away in a reserve, and only bleed it into their earnings incrementally as the, insurance services were actually provided.
Because it drastically altered the immediate optics of their balance sheet, it just spooked the market into thinking the cash had evaporated.
Exactly. But the cash was always there.
And we saw that narrative begin to turn. Right?
Yeah.
In our deep dives covering Q1 and Q2 of 2025, we watched them fight back. We looked at how premium growth was battling rising insurance costs. Then came our deep dive on Q3 2025, which was kind of the watershed moment.
Yeah.
They delivered this massive 29% profit leap.
Yeah, that was huge.
Proving they had adapted. And suddenly, that strong dividend outlook was back on the table. Looking at the stock now compared to our very first analysis, it's like a totally different narrative.
Well, what's fascinating here is that Allianz Malaysia has transitioned from a story of regulatory uncertainty into a highly predictable dividend-yielding engine.
Right.
The Q2 2026 results we're looking at today show a management team executing a deliberate strategy to insulate their earnings.
Okay, let's unpack this. We need to look at the top line and bottom line numbers for Q2 2026 to see if the data actually supports that.
Sure. So the broader numbers show steady growth. For Q2 2026, total insurance revenue hit 1.63 billion ringgit.
Okay, so that's up, what, 7%?
Yeah, 7.2% increase year over year. And looking at the first half of the year as a whole, the 1H26 numbers total revenue reached 3.26 billion ringgit.
Okay, but revenue is just the starting point. We always want to know what a company actually gets to keep.
Right. Profit before tax, the PBT, grew a very healthy 9.9% year over year for the quarter, landing at 311.2 million ringgit.
Wait, I have to push back here. I am looking at the final take-home pay, the profit after tax.
Okay.
If the pre-tax profit is up nearly 10%, why did the PAT, the profit after tax, only creep up by like 2.2% to 218.7 million ringgit?
That's a fair question.
Did they suddenly experience a massive surge in operational costs at the end of the quarter?
No, actually. Reading the top line summary without digging in will lead you to that conclusion, but this discrepancy has nothing to do with operational failure. It's a tax nuance.
Oh, really?
Yeah, we have to look at their effective tax rate, the ETR. In Q1 of 2026, their ETR was around 20%. But in Q2, it spiked dramatically to 29.7%.
Wait, almost 30%? Why does a company's tax burden jump 10 full percentage points in a single quarter?
The tax authorities mandated a reclassification of the investment income, specifically within ALIM, the life insurance segment.
Oh, gotcha.
Yeah, the regulator required an 8% tax on investment income after allowable deductions for the life business. Because this hit the books in Q2, that quarter absorbed an unusually high tax burden. Oh, I see.
If you zoom out and look at the entire first half of 2026, the overall ETR smooths out to 25.1%.
He's pretty normal.
Perfectly in line with the 24.8% they recorded in the first half of 2025.
So it's a quarterly accounting anomaly, basically a temporary tax hit, not a fundamental deterioration of the business.
Exactly.
But to really understand how they make their money, we can't just look at the blended total. We have to separate those two distinct engines, general and life. Because looking at the Q2 breakdown, they had wildly different quarters.
It was very much a tale of two segments. Starting with AG, the general insurance arm, they faced a notably difficult quarter.
Yeah, I saw that.
Their profit before tax actually slipped 5.9% year over year, dropping down to 144 million ringgit.
So what dragged the general engine down?
Claims. Gross claims spiked 21% year over year.
Wow.
And quarter over quarter, too. This surge was heavily concentrated in their motor insurance business.
Cars. Right. Because of this spike, their gross claims ratio jumped to 65.9%, up from just 56.9% in the same quarter last year.
That is a big jump.
Yeah, the frequency of accidents increased, and crucially, the cost of parts and labor to repair those vehicles went up significantly.
Well, 21% spike in claims is a heavy blow for any insurer. But honestly, this perfectly illustrates the structural defense of a diversified model.
How so?
Well, because while Aegis was absorbing those spiking motor claims, ALIM, the life insurance side, completely carried the quarter.
They absolutely did. ALIM's performance was incredibly robust. Their profit before tax surged 29.7% year over year, hitting 166 million ringgit.
So what was the catalyst for that surge?
A massive 16% year-over-year growth in gross written premiums, or GWP. They saw fantastic traction in their investment-linked protection policies and their employee benefits business.
Oh, wow.
Plus, favorable market conditions resulted in strong fair value gains on their existing investment portfolio.
So it's kind of like an airplane with dual engines, right? When the general insurance engine hits a pocket of turbulence, like those spiking motor claims, the life insurance engine throttles up to keep the altitude steady.
That's a great way to look at it.
The whole plane stays level. It's the beauty of their diversified model.
Mm-hmm.
Which brings us to our proprietary Financial Moat Scorecard.
Right, the moat.
In our previous deep dives, we gave Allianz Malaysia an 8 out of 10. Given that AJAK's claims spiked 21%, the obvious question is, should we downgrade that score? Is the moat shrinking?
Well, looking at the Q2 data against our criteria, the score remains a rock-solid 8 out of 10.
Really? Even with the claim spike?
Yeah. The Q2 results actually reinforce their competitive advantages. It proves they can absorb a severe operational shock without breaking their profitability streak. We measure this across 4 specific pillars.
Okay, let's run through those pillars. Pillar 1 is scale.
Right, scale in insurance dictates survival. It lets a company spread massive fixed costs across a much larger pool of premium revenue.
Like IT and compliance.
Exactly. AJAK remains the undisputed market leader in Malaysian general insurance with a 13.3% market share.
That's massive.
And ALIM is rapidly scaling as one of the fastest-growing life players. Their ability to outprice smaller competitors hasn't diminished at all.
Okay, pillar 2 is underwriting discipline. This always comes back to the combined ratio, which is arguably the ultimate measure of an insurer's true moat. Walk us through how that functions.
So the combined ratio simply measures an insurer's incurred losses and operating expenses against the premiums they earn. It's a percentage.
Right.
If the ratio is under 100%, the company is generating an underwriting profit from its core operations before they even invest the premium money.
Okay, so under 100 is good.
Right. The industry average in Malaysia hovers around 90 to 91%. Despite that massive 21% spike in motor claims, AGI's Q2 combined ratio remained at 88.9%.
Oh, wow.
And for the entire first half of 2026, it was even lower at 87.6%.
So even when they take a direct hit, their underwriting standards are so strict that they are still operating well below the break-even mark.
And outperforming the industry average. That is real pricing power.
Amazing. Pillar 3 is the balance sheet fortress.
Yes. Allianz Malaysia has 0 bank borrowings. No corporate debt on the balance sheet aside from standard lease liabilities.
That's incredible.
Plus, their capital adequacy ratio, the CIR, far exceeds the 130% minimum mandated by Bank Negara Malaysia.
So they have plenty of cash.
We're sitting on a 28.19 billion ringgit liquid investment portfolio. They have the capital reserves to weather almost any shock without raising expensive capital.
Okay, that brings us to Pillar 4, the CSM buffer, which honestly feels like a secret weapon on their balance sheet.
The contractual service margin. This ties directly back to that MFRS 17 accounting standard that caused all that panic in 2024.
Right, the reserve thing.
The CSM is essentially a ledger that tracks unearned profits from contracts they've already sold. This profit is held in reserve and released into the income statement gradually over time.
Okay, so in Q2 2026, where is it at?
Their CSM actually grew to 3.8 billion ringgit.
Okay, so think of the CSM as water held securely behind a massive dam. It's a reservoir of locked-in future profit.
Right.
Even if there's a drought in new sales next quarter, they can just open the dam and let those previously secured profits flow into the income statement.
Exactly. It smooths out their earnings and turns a volatile business into a highly predictable earner. The visibility that gives institutional investors is incredibly valuable.
Okay, so if the scale is dominant, underwriting is beating the average, zero bank debt, and a 3.8 billion ringgit profit reservoir. Why are we capping them at an 8 out of 10? Why isn't this a 10?
Well, despite their internal excellence, they face severe structural and regulatory constraints. There are three primary headwinds.
Okay, hit me with them.
First is the medical inflation lag. Healthcare costs in Malaysia are soaring. Allianz did reprice their medical premiums by the maximum allowable 10% in April 2025.
Okay, so they raised prices.
Yes, but Bank Negara Malaysia regulations force insurers to spread out any medical premium hikes over a period of at least 3 years.
Wait, let me make sure I get the mechanics of that. If a hospital suddenly doubles the cost of a knee surgery tomorrow, Allianz cannot just hike their premiums next month to cover it.
No, B&M enforces this 3-year spread to protect consumers from sudden price hikes. It's great for policyholders, but it severely limits how fast the insurer can react.
They just have to eat the cost temporarily.
Yeah, they absorb the immediate blow, creating a squeeze on their profit margins until the premium hikes fully phase in.
That is a heavy regulatory leash. What is the second constraint?
The limitation on capital mobility. Dividends are not at the sole discretion of management.
They need approval.
Right, explicit approval from B&M before they can pay a single ringgit in dividends. The regulator mandates this to ensure strict capital adequacy.
Which is exactly what caused that skip dividend back in late 2024, right? The cash was there, but the approval was delayed.
Exactly. And the third red flag keeping the score at an 8 is the MyCC litigation.
Oh, the antitrust thing.
Yeah, AGC is still fighting a lingering appeal against the Malaysia Competition Commission. They've had some procedural successes, but the schedule extends deep into 2026. It's a persistent contingent liability.
Okay, so medical inflation lags, dividend handcuffs, and an antitrust lawsuit. That certainly justifies capping the moat at an 8. But a good management team doesn't just accept constraints. How are they fighting back?
Well, to combat the medical inflation lag, management is aggressively pivoting toward new co-payment medical products.
Oh, interesting.
Instead of absorbing 100% of the soaring hospital bills, these new policies require the consumer to pay a percentage of the upfront cost.
Which completely changes the behavioral economics.
Exactly. By sharing the cost, it deters frivolous claims. Patients don't just choose the most expensive private hospital for minor issues anymore.
Because now they have to pay 10% of that massive bill.
Management's goal is to use these copay products to force their medical claims ratio back below 85% in FY26.
That makes total sense. What else are they doing?
They're aggressively pursuing high-margin commercial sectors. Their biggest focus right now is ensuring data centers.
Okay, here is where it gets really interesting, but I have to push back. Malaysia is seeing a massive boom in data center construction, especially in Johor.
Absolutely.
But a data center is a heavily concentrated risk.
Yeah.
If a massive server farm catches fire, you are looking at a multi-hundred million ringgit payout.
It is a massive risk.
Isn't the whole point of an insurance moat to pool risk across like hundreds of thousands of small motor policies? Why take on such concentrated commercial risk?
Well, AGC mitigates this through heavy use of the reinsurance market. They essentially buy insurance for their insurance.
Oh, I see.
They offload the catastrophic tail risk to global reinsurers while keeping a highly lucrative portion of the premium for themselves. Plus, the underwriting margins on specialized commercial property are vastly superior to the highly competitive motor market.
So they're leveraging their dominance to capture this booming asset class before competitors can figure it out.
Precisely.
So, synthesizing all this, the top-line growth, the claim spike, the CSM profit dam, and this aggressive data center pivot. How was the market pricing the stock? I pulled the analyst notes from RHB and TA Securities, and their math is highly conflicting.
Yeah, two research houses looking at the exact same statements and applying totally different lenses.
Right. RHB maintained their BUI rating and raised their target price to 24 ringgit and 50 sen, baking in a 6% ESG premium. And TA Securities also maintained a BUI rating, but kept their target unchanged at 24 ringgit and 35 sen.
So they generally agree on the target price.
They do. But the PE ratios they publish do not match at all. RHB says it's trading around 7.9 times earnings, but TA Securities says it's a dirt cheap 4.3 times. How are they nearly 100% apart?
It comes entirely down to how they count the shares.
Really?
TA Securities uses basic outstanding shares, which is about 184.3 million shares. They are valuing the company based strictly on its present reality.
Okay. And RHB?
RHB uses a fully diluted share base of 346 million shares.
Where do an extra 160 million shares come from?
RHB is factoring in the eventual conversion of the ICPS.
The irredeemable convertible preference shares.
Exactly. When those convert into regular stock, the earnings pie has to be sliced into 346 million pieces instead of 184 million. This dilution pushes the PE ratio up to 7.9 times.
But frankly, even if you rely on the more conservative 7.9 times multiple, that is an incredibly cheap valuation for a market leader in the financial sector.
It's a deep discount, especially when you factor in the primary catalyst right now, the dividend yield.
Oh, the ultimate redemption arc from our 2024 analysis.
Yeah, after skipping that dividend in 2024 to conserve capital, their payout policy has roared back. Management has returned to an aggressive dividend stance.
So what are analysts projecting?
Robust forward dividend yields between 5.9% and 6.6% for FY26 and beyond.
A 6% yield on a stock growing its top line by 7%, with zero bank debt and billions in unearned profit reserves. I mean, it shifts the whole investment thesis.
It really does. You're getting paid handsomely while you wait. It's a premier dividend compounder.
All right, so just to quickly summarize, Allianz is successfully firing on its dual-engine model. The general insurance segment took a hit from the motor claims, but the life insurance segment surged to balance it out.
And they easily maintain their 8 out of 10 Moat score.
Yeah, because of the scale, the underwriting discipline, the debt-free balance sheet, and that 3.8 billion ringgit CSM profit reservoir.
They do face legitimate headwinds, you know, the medical repricing lag, dividend handcuffs, and the antitrust litigation.
But their pivot toward co-payment models and data center insurance shows an adaptive management team. Add in the cheap valuation and a near 6% dividend yield, and that consensus BUI rating makes total sense. The invisible fortress in action.
Exactly.
Well, before we sign off, I want to deliver a very sincere thank you to you, our listener, for joining us on this deep dive. We love untangling these complex reports.
We really do.
Please give this video a like and leave a comment below. We really want to know your thoughts on Allianz's data center strategy, and drop the names of any other stocks you'd like us to cover next. And of course, hit subscribe so you never miss a deep dive.
And I want to leave you with a final thought to mull over. What's fascinating here is we discussed Bank Negara Malaysia's strict regulations, capping their ability to raise medical prices or pay a dividend freely.
Right, the regulatory leashes.
But consider this.
Yeah.
Do these exact regulatory handcuffs actually force insurers to become more efficient and innovative? If Allianz could just hike prices instantly, maybe they wouldn't have bothered with co-payment models or pivoting so aggressively into the data center market.
Wow, yeah.
Perhaps the heavy hand of regulation is the exact pressure required to forge a stronger, safer company for long-term investors.
A fortress built stronger, precisely because of the pressure pushing against its wall. I love that. Keep digging, keep learning, and we'll see you in the next deep dive.